On March 25, 2024, the European Securities and Markets Authority announced the completion of its first set of regulations for crypto asset service providers under the Market in Crypto Assets Law. Regulatory frameworks play a crucial role in shaping the industry's trajectory. Among these, the European Union's Market in Crypto Assets Regulations have emerged as a significant milestone aiming to provide a comprehensive framework for regulating crypto assets and related activities within the EU. Now, I understand this is not the most exciting video you'll ever see from me, nor is this message in this video something people might want to hear, but it has to be said and told. In this video, I'm going to tell you all about MiCA and the implications it has to stablecoins. The European Commission presented the MiCA proposal on September 24th, 2020, and it is part of a larger digital financial package which aims to develop a European approach that fosters technological development and ensures financial stability and consumer protection. In addition to the MiCA proposal, the package contains a digital finance strategy, a Digital Operation Resilience Act called DORA, and that covers crypto asset service providers as well, and a proposal on distributed ledger technology pilot regime for wholesale users. So what is MiCA, right? Well, to simplify it for you, MiCA seeks to categorize and define various types of crypto assets, providing clarity and legal certainty for market participants. And these assets range from cryptocurrencies like Bitcoin and Ethereum to stablecoins and utility tokens issued through initial coin offerings. Now, by defining these categories, MiCA establishes clear regulatory requirements tailored to the specific characteristics and risks associated with each type of asset. And one of the key aspects of MiCA is its focus on regulating crypto asset service providers, including exchanges, custodians, and wallet providers. Now, these entities are required to obtain authorization from competent authorities, adhere to strict operational standards, and implement robust anti-money laundering and know your customer procedures. And know your customer procedures are a set of processes that financial institutions and businesses implement to verify the identity of their customers, assess their suitability, and evaluate the risk associated with their activities. Now, these procedures are primarily aimed at preventing financial crimes, such as money laundering, terrorist financing, and fraud. The procedures involve several steps, like identity verification, where initially customers may submit their identification documents either in person or through electronic means, and then these documents are then verified using various authentication methods, including document scanning technology, biometric verification, and database checks. And then you have a basic risk assessment of the customer, which is based on factors such as their location, occupation, financial history, and the nature of their transactions. And that helps determine the level of scrutiny required for the customer. Now, besides the basic risk assessment, there is also an enhanced due diligence investigation, which are for customers deemed to pose a high risk. Think of people like political exposed persons, which is PEPs in short, or those involved in high value transactions. Additional verification steps may be necessary, and this can include obtaining additional documentation, conducting background checks, or seeking clarification on the source of funds. Now, two other things are ongoing monitoring and record keeping. Now, institutions continuously monitor customer accounts and transactions for any suspicious activities or changes in behavior that may indicate potential illicit activities. And this involves implementing automated systems and manual reviews to detect anomalies and red flags. Now, these institutions are also required to maintain records of customer identification and transactional information for a specified period as mandated by regulatory authorities. Now, these records serve as evidence of compliance within KYC regulations and are subject to audit by regulatory agencies. Now, a fun story is that I've actually left a job where I was doing this. We had a set of analysts who were reviewing clients, so either natural persons, PEPs, or maybe business clients. They had to write reports, and I was the one auditing their reports to see if they mentioned all the risks in the report, if they saw all the risks, and if not, which other risks still need to be addressed in that file. So this entire topic is actually something that I had to work with every single day. Now, I know that some of you might hate the KYC part of crypto and are actually looking for exchanges that allow you to trade without it, but personally, I'm in favor of KYC. The reason for that is that it helps safeguard your funds, my funds, but it's also preventing money from being used for illicit purposes or by the wrong people. And since we're taking a break now anyways, I want to quickly remind you that I'm not a registered financial advisor. My videos are meant to be educational and entertaining only, and always do your own research and only invest money you're willing to lose, because even though you can gain a lot in crypto, you will most likely lose it all. Now let's say you do get filthy rich in crypto, it's very important that you safeguard your crypto. Now we all know not your keys, not your wallets. I'm using a hardware wallet, which is the Tangent one, because it's very convenient. All you need is your phone and your wallet to be able to utilize the hardware wallet. Now I made a separate video about it, be sure to check it out, and if you feel like buying this hardware wallet, be sure to use my coupon code, because that will give you an extra 10% off as well. Okay, let's continue with the video. So besides all of this, MiCA also introduces provisions to address potential market abuse and insider trading in the crypto asset market, mirroring regulatory frameworks established for traditional financial markets. Now by implementing rules on market manipulation and insider trading, MiCA aims to foster trust and confidence in digital asset markets, attracting institutional investors and facilitating mainstream adoption. Furthermore, MiCA seeks to promote innovation and competition within the EU's digital asset ecosystem by establishing a streamlined process for issuing and trading crypto assets. Now, through a harmonized regulatory framework, MiCA aims to create a level playing field for both established players and emerging startups, fostering a vibrant and dynamic market environment. MiCA EU regulations apply to service providers involved in the trading, management, issuance and advice of crypto assets, and that includes exchanges, crypto trading platforms, custodial wallets and advisory and management firms in the EU. It also applies to crypto asset issuers and service providers outside the EU who wish to do business with any member states. Now, MiCA crypto regulations clearly define crypto assets that use decentralized ledger technology, with specific distinctions between cryptocurrencies and tokens. The regulatory framework covers three distinct crypto assets: asset reference tokens, e-money tokens and utility tokens. So those are crypto assets that are not EMTs or ARTs. Now MiCA applies stricter rules for stablecoins, requiring legally binding stabilization mechanisms to ensure they are adequately backed with good liquidity to instill user confidence. Now stablecoins are divided into e-money tokens and asset reference tokens. An e-money token is a crypto asset designed to maintain a stable value by referring to one currency, while asset reference tokens are crypto assets that seek to maintain a stable value by referring to several cryptocurrencies, commodities or other crypto assets, or a combination of these assets. Where these become more systematic, they will be subject to enhanced rules. So what MiCA means for stablecoins is that stablecoins are a big factor in crypto, and when you on-ramp your fiat to crypto, you most of the times exchange it for stablecoins and then trade them for crypto. When you sell your crypto, you most likely exchange them back to stablecoins again. Now some people do this to off-ramp the crypto again, and some people keep a bag of stablecoins to buy the dip. Now let us know in the comment section down below what your most favorite stablecoin is and what the reason is that you hold this in your portfolio. Now what's important to know is that MiCA does not introduce entirely new regulations for fiat-backed stablecoins. It just confirms that stablecoins issuers must be regulated as EMIs, which stands for Electronic Money Institutions. Now why did I write in the title that you should ditch USDT and so am I? Well, the reason for this is simple. As it stands, MiCA will require all EU exchanges to delist stablecoins whose issuers do not have EMI licenses in the EU. And if left as is, this could have an impact on the European crypto market and the competitiveness of European crypto exchanges in a global market. Large exchanges already started to phase out USDT trading in Europe ahead of MiCA. As of March 2024, USDT was the third largest cryptocurrency after Bitcoin and Ethereum, and also the largest stablecoin. Now, USDT is issued by Tether, a company owned by iFinex, the Hong Kong registered company that also owns the crypto exchange Bitfinex. Now, the value fluctuates with the US dollar and is backed by Tether's dollar reserves. Under MiCA, stablecoin issuers would be required to disclose information about the reserves, undergo regular audits and adhere to reporting requirements. This enhances transparency and trust in the stablecoin ecosystem. Now Tether never had an official audit, only an attestation, which means that they have just shown BDO a snapshot. Now one of the primary impacts of MiCA on stablecoins, including USDT, is the requirement for issuers and service providers to obtain authorization from competent regulatory authorities within the EU. And this authorization process entails compliance with stringent regulatory standards, including capital requirements, governance structures, and operational safeguards. Now for stablecoin issuers like Tether, this means they would need to adhere to these regulatory requirements to continue operating within the EU market. Now OKX is actually one of those exchanges who phased out USDT ahead of MiCA. It's the fourth largest exchange globally and has announced the discontinuation of Tether trading pairs for users who are located in the European Economic Area. OKX's customer support stated in the recent information that Tether had been removed from EEA traders on the 14th of March. And this was in spite of the evidence on the OKX website, which claims that USDT pairs were up for grabs in Europe until the 15th of March. Now this lack of reconciliation has led to fears that the exchange is not ready for regulatory changes. The proactive measures taken by OKX are part of a bigger trend in the cryptocurrency sector, however. The exchanges are shifting their work more towards compliance with tough financial regulations. However, MiCA's regulatory approach has sparked debates and discussions within the crypto community in regulatory circles. Some argue that overly stringent regulations may stifle innovation and drive businesses outside the EU jurisdictions, hampering the region's competitiveness in the global digital asset market. Conversely, proponents argue that regulatory clarity and investor protection provided by MiCA are essential for fostering long-term growth and sustainability in the crypto industry. By subjecting service providers to regulatory oversight, MiCA aims to enhance transparency, reduce systematic risks, and safeguard the interests of investors and consumers. So what are you going to do? Let us know down below. Be sure to subscribe and I'll see you guys next time. Doei!